In our base case scenario, we do see the Federal Reserve aggressively hiking rates this year and tightening financial conditions, but over the next 12 to 24 months, we do see them ultimately falling short of what they view as a neutral rate and eventually having to reverse course. We see consumer spending remaining robust. We do see shifting consumer preferences, albeit not enough to be meaningfully deteriorating to corporate revenues. Finally, we do see potential for slower growth overall here in the US in 2022, but remaining positive for the calendar year. From an allocation perspective, we would continue to emphasize quality and a potential tilt towards the value-oriented sectors and industries and companies in the market today. And on the fixed income side, we continue to prefer lower duration, just given the level of uncertainty from an interest rate trajectory, and prefer investment grade over high yield at this juncture, given the potential for volatility. In a bear case, we could see the Federal Reserve here in the US ultimately hike too fast and tighten financial conditions in a way that tips the US into a recession. We could see consumer spending slow a little bit quicker than we are thinking right now, and we could see inflation remain ever persistent and not get some of the natural moderation that we're expecting. From an allocation perspective, we would remain convicted in some of the higher defensively oriented businesses and industries, but also we would start thinking about selectively adding to some of those dislocated industries and companies that we talked about in our base case, because at this point, with the market already off 23.5% from a price perspective, realistically from a valuation perspective, you're starting to get some pretty good deals. In fixed income, we'd look to lengthen duration and stay closer oriented to government securities and stay away from high yield in a bear case scenario. In our bull case scenario, we see potential. We can't rule out the fact that the Fed may execute a soft landing. We may see consumer spending remain robust and get some of the natural moderation in inflation. And we might see corporates respond very well to this and be able to flexibly allocate capital to reorient themselves around growth. From an allocation perspective, we would continue to emphasize quality here, but we would be looking to tip our toe a little bit more into cyclical and growth-oriented sectors and industries. On the fixed income side, borrowing would ramp up, and so spreads would be looking to tighten, which would benefit some of the riskier issues, and we would be comfortable, most likely, adding to a high-yield allocation here.